So here we have the market trade above. Now watch. If this is bullish, if they want to make a run to take out, say, the 930 opening candle, and that's like right here, right there. Watch price action in here. This is okay, but you can't leave bodies in the lower half of that. Can't do that. They'll get this inefficiency here. This has not acted as inversion yet. About like a mountain climber. Okay, I've used this analogy before. Say this is the rock surface that you're standing below the base of. Okay, here's the part at which if you climb to that high, that's the goal. So this is the range you're inside of, and whenever you're looking for things to tape read, to practice, it's not an ego report card. It's not about trying to do a demo account trade. What you're trying to see is what signatures are in play right now based on what you're watching in price action. Let me put this consequent encouragement on real quick. Okay. This range there, half of that would be, where are we at? Low to high. Yeah. So we traded just above. So we went to a premium, but failed to get into this inefficiency. So that by itself, if it were Thursday, not Friday, I would be selling more here, looking for that low to be taken out, because it didn't get to this one here. I'm still leery of that. So I'm looking at this here as a low day for right now to see if the evidence around these levels here can support the price. So far, it has not acted as inversion fair value gap. So since it's moved above it, now we went down below it. If it can climb outside of it here, then the criteria is this stays kind of like a no trespassing. You can't leave a body down in here. This painting back and forth, this is the part that people think, oh, they don't work. It doesn't work. You have to have the understanding of what it is it's supposed to be doing. By it trading above it here, that's wonderful. Now it becomes, now you can watch and see, does it give you the scenario? It validates it by taking it out on the downside. So what has it done by doing so? It trades above it and below it. So now this takes on the characteristic of a balanced price range. That specific candlestick right there, that's what it's doing. That's the function. Okay. When the algorithm refers back to these levels, it uses scripts and logic to support price or reject at those levels. We went below it here. So now we've done two passes. We've done buy side delivery, not liquidity. That means just movement through a range up. Then it had sell side delivery, which is movement simply going lower. So now if this PD array is valid, and it should act as a inversion fair value gap, that can only be done now if it trades outside of it. And then any movement back down into it here needs to support the idea that it's not going to be willing to lay a body in the lower half once it leaves the upside of it here. This part here. This is not enough. It's got to do it on a body basis. It's got to close outside of it. That's inversion fair value gap. And if you're not seeing those things happening, you can't come back and say, see, it doesn't work here. It doesn't work here. It doesn't work. And I have so many people literally in my comments, this thing failed here. This thing failed here. And you look at price action, it's like, you don't even know what you're doing. I'm going to compare the S&P with these highs right here. Okay. Just give me a second. MES. See that? That's a little S&P divergence right there. NQ. It could stab down there and get that consequent encroachment of that wick. See the bodies on the low of that right there. So right now it's still operating underneath the idea of a reclaimed bearish SIBI, or sell side imbalance, buy side inefficiency. When you're tape reading, you're not trying to hold yourself to being right or wrong. You're just trying to collect information on how price reacts off of specific things. You're basically in here trying to see if there's rules that I've submitted on this YouTube channel and in audio lectures also, in like Twitter spaces and whatnot. If that logic is in play with what you're watching in price action, if you're seeing those things happen, then you are probably in a market condition that is conducive for good paper trading. Let's say it that way. But in the beginning, you shouldn't expect to know what you're doing, because you have to discover whether or not these things I'm teaching you hold water or not. So many of you skip over that, and you think, well, he must be teaching what works, and people talk about they make money doing it. So let me just go out here and try to use it and try to pass a funded account or trade with live funds. And you discover you don't know what you're doing. And instead of being responsible and saying, well, I didn't really do the job of testing it, back testing it, figuring out how I'm supposed to do it myself for a couple months in a row, you just jumped ahead and tried to just FAFO, and then you did. And you can't walk away with that and say, this stuff doesn't work. It just means that you didn't know how to learn how to use it first. Small little gap here. Volume imbalance there. We trade up into that. It would need to sell off this candle or immediately the next one to get below consequent encouragement if it was bearish. Like, say, for instance, I was short. I'm not short or long. I haven't done any trades today at all. But based on what we're seeing here, it would need to get real animated to the downside here. This line off here, because all this line here is simply just measuring premium to discount. This is equilibrium right here between this high and that low. If you watch that, see the red line moving around? That's just anchoring to midpoint. So we went to a short-term premium here, traded lower. I would be a little nervous if I was short, simply because it's spending way too much time in this range. I would want to see it get real aggressive to the downside. See? It's off now. Now, if it wants to continuously go below this low here, let me thicken this up quick. What I'd like to see is this portion of this gap here. I would like to see that stay open. If it can stay open and trade below that low, I like to see those types of things in price action, because it's showing potentially a breakaway. But if it comes back up and closes that in, I don't like to see that. So in your notes, when we're on a Friday and we're looking for a low, even though we're bearish, or let me rephrase that, even though I'm bearish long-term, intermediate term, moving below old lows is always a welcome thing. You know, that's the direction, that's what we're looking for. But if it's doing so in a manner where it's on a Friday, it's been one-sided right from the opening, if it has these little gaps like this and it fills in that gap, I don't like that, because two things can happen. Number one, it can trade above this here and use it as support to go higher, or any run below that low could now be stunted. In other words, not see a whole lot of continuation below it. It can, but it's more likely, in my experience over the last 30 plus years, these types of scenarios, I'd rather see them stay open and then go below that here. And then everybody else would expect it to trade back up above this low to get to that gap and then go short. That's not what usually happens. Think about Think about what I've already said to you about how picking fair value gaps. What are we anticipating here by being bearish? Well, if we're bearish, we would want to see this low get taken out. So a fair value gap, before it does that, what have I been teaching you? They act as inversion fair value gaps. So now you understand the logic, okay? You already know more than most people out there trying to teach inversion fair value gaps and trying to get paid doing it. All for free. All for free. And wait till